Welcome back to the Deep Dive. Today, we are staring directly into an economic paradox that, well, it should be demanding everyone's attention.
They really should.
We're looking at this bizarre, frankly urgent disconnect across the global economy.
Yeah.
You have mass layoffs, everywhere, across almost every sector.
And at the same time.
At the exact same time, corporate financial reports are coming out with these record-breaking, just eye-watering profits.
And that's the core dilemma, isn't it? This phenomenon, it violates the central tenets of economic logic, the very logic that, sustained the middle class for the last century.
Right. It used to be simple.
It was. For a corporation to grow, to achieve that exponential growth and deliver massive value, it fundamentally required a proportional investment in labor, in people.
If you fired everyone, your company died.
Exactly. You were kneecapping your own ability to operate, to innovate. Labor was the fuel. It was the necessary, non-negotiable fuel for the growth engine.
But our sources are confirming that this engine, it's been fundamentally replaced. And the result is what the big institutional players, the smart money, are calling the Great Decoupling.
It's a massive divergence, a signal break.
Where corporate success is no longer tethered to human necessity. That traditional link between a company getting bigger and more people getting jobs, it's been severed.
And the smart money isn't just watching this happen. They're not just tracking it. They're actively repositioning their entire portfolios to exploit it.
And that defines our mission for this deep dive.
Yeah.
We need to move past the headlines and look at the secret metric. The one that has quietly replaced headcount as the true indicator of value.
Revenue per employee. Understanding that mathematical pivot is, I think, the only way to position yourself for what's becoming a massive agentic wealth transfer.
This isn't just about clever chatbots anymore, is it?
No, not at all. This is financial. It's mathematical. It is the moment where capital is quite literally declaring war on the necessity of labor.
So what does this seismic shift mean for you, the listener? It means the rules of the game have changed. Your career, your investments, your strategy has to pivot right now to reflect this new reality.
Right.
We're going to unpack the Klarna case study, the moment that proved human replacement isn't just possible, it's aggressively profitable.
We'll also get into the economic physics of it all, the crossover point.
Moore's Law versus minimum wage, and then at the end, we'll deliver the offensive playbook. How to stop competing with a zero-cost digital worker and instead start owning the infrastructure that employs them.
We've synthesized a lot of material for this. Market analyses, internal investment theses from some major funds, corporate operating notes. The goal isn't to overwhelm you.
It's to give you the concentrated, actionable knowledge you need to navigate what's happening. And it is happening fast.
Very fast.
Okay, so let's start by unpacking the hard evidence, this great decoupling. For most of the 20th century, if you were a Fortune 500 company, success meant your headcount was growing.
Right. Growth meant hiring. More people, bigger problems, and that, in turn, fueled the massive expansion of the middle class.
But today, that's flipped. The most valuable growth isn't just happening without human employment. It's happening because of its absence.
Labor is no longer the fuel. In the corporate budget, it's become the friction. The engine has been completely redesigned, and it runs on efficiency, on compute, and increasingly on autonomous software agents.
To really get the scale of this, we have to look at the timeline.
Yes. The data points we've compiled show this exponential concentration of wealth generation with fewer and fewer biological costs.
So let's run the clock back. Post-war analog world. Where's the money coming from?
Think 1950. General Motors. You could argue it was the most powerful economic engine in the world, the absolute bedrock of the American middle class.
And to make their money.
To generate billions in today's money, the kind of revenue that built suburbs, that funded pensions, GM needed a colossal 500,000 employees globally.
500,000.
That headcount was an unavoidable cost, sure, but it was also the mechanism. It's how that immense wealth got distributed across society.
Okay, now fast forward. The first wave of digital disruption, early globalization.
Jump to 2015. You're looking at giants like Google or Facebook, the first era of digital dominance. They were generating comparable or even higher revenues than peak GM.
But with how many people?
About 50,000 employees.
So a tenfold increase in efficiency.
A massive leap. And that was the first real crack in the foundation. It was this huge jump in what the financial world was starting to call revenue per employee.
And that brings us to right now, the age of generative AI.
Look at 2025. A company like OpenAI is the poster child here. They're generating incredibly high accelerating revenues that are already reshaping entire industries.
With fewer than what, 2,000 employees?
Under 2,000 employees, the compression is just staggering. You go from 500,000 workers to 50,000, now down to less than 2,000. And all while maintaining or exceeding the previous revenue scale. That trend line is the undeniable proof of the great decoupling.
And that's what severed the link. This ability to make massive, sustained revenue with a tiny headcount. And the metric driving all of this, the one that institutional investors are obsessed with, is revenue per employee, or RPE. Can you ground that for us? In corporate finance terms, why is that number suddenly everything?
Absolutely. RPE is a pretty straightforward efficiency ratio. It tells an investor how much revenue is generated for every single human you have on the payroll. But what the smart money is really tracking isn't just revenue.
It's profitability.
It's the ratio's correlation with profitability. A high RPE signals that a company can scale its revenue, its top line, without scaling its most volatile and expensive cost.
Right.
People, the payroll.
So every dollar you make without hiring someone
Goes almost directly into high non-free cash flow. The higher that RPE goes, the more robust, the more profitable the company is. It's a sign of financial immunity to things like wage inflation.
Which brings us to this huge disconnect between what we're being told publicly and what's actually happening inside these companies. The polite lie.
The polite lie, yes. This is the PR messaging you hear everywhere. AI is just a co-pilot. It's a tool to make humans more efficient.
And all those people whose jobs get automated will just pivot to higher level, more creative work.
It's a narrative that's, emotionally soothing. It's designed to minimize social friction, to keep the workforce compliant while this transition happens.
But it's not the truth.
It's not the financial truth. If you look at the balance sheets and the corporate actions we're about to get into, the reality known and acted on by CEOs and major investors is much harsher. AI is, in most cases, the direct cost-effective replacement for the worker, not their assistant.
The choice isn't about helping a $5,000 a month employee be 10% more productive.
No, it's about replacing that person entirely with a $5 a month agent that does the core job 500% better, 24/7, without any overhead.
The margin difference is just too big to ignore.
The math is inescapable. And the conclusion you have to draw from this, from the RPE metric, is that capital no longer needs labor to win. For 100 years, that relationship was symbiotic. You needed both. Now, capital provides the infrastructure and the automated operators.
Leaving labor out of the equation.
And that's why, based on this core efficiency metric, labor is losing its leverage against capital, rapidly and decisively.
To really see how this is being executed, this hostile takeover of the payroll department, we have to look at the business models themselves. The way software is being sold has completely changed. We've moved from SaaS,
software as a service,
to what our sources are now calling service as a software. This is the weaponized business model.
And we have to define that leap because it's the mechanism that's driving the layoffs. SaaS 1.0, the model that powered the last big tech boom, was all about selling a tool, a subscription. Think of Salesforce, a CRM.
Right. You'd pay $50 a month per user or something like that.
Exactly. The software cost was, in the grand scheme of things, pretty negligible. But the company buying that software then had to go and hire a human salesperson or a customer service rep to actually log in and use it.
And the human was always the expensive part of that stack.
Overwhelmingly. The salary, benefits, sick leave, management, training, that was the real cost. Thousands of dollars a month. The CEO bought the tool, but they still needed that expensive, sticky human layer to deliver the actual business result.
But that whole model has now been turned on its head.
Yes. SaaS 2.0 is a transition to service as a software. The new model is selling the result, the service itself, which makes the human in the middle redundant. Instead of selling the CRM tool, a company is selling Agent Force. They're selling the automated salesperson that uses the tool.
You're not buying the hammer anymore, you're buying the finished table.
Perfectly put. And nothing illustrates this with more brutal clarity than the Klarna case study. This was the smoking gun. This was the moment that every CFO and CEO in the world sat up and went, oh, okay, this is real.
So what happened at Klarna?
This unfolded in early 2024. A textbook hostile takeover of the payroll department. Klarna, the big global payment service, deployed an internal AI customer service agent. And crucially, it wasn't there to assist the staff.
It was there to replace them.
Specifically to replace them and handle the entire volume of customer interactions autonomously. And the replacement was immediate. Our sources confirm the AI agent replaced the work of 700 full-time human agents.
700 jobs.
Gone. Not through gradual attrition. This was a mass redundancy event driven purely by financial efficiency and performance.
And the performance data was pretty terrifyingly impressive.
It's what caused the shockwave. In its very first month, the AI agent handled 2.3 million customer conversations,
2.3 million.
a volume that would normally require thousands and thousands of human hours. And it did this fluently in 35 different languages, instantly scaling globally without the cost of hiring multilingual staff.
And the operational benefits go way beyond just speed and volume.
Oh, absolutely. The agent worked 24/7, no shifts, no overtime. It didn't take sick leave, didn't need vacation, didn't need pension contributions. And the real kicker, from a cost perspective,
It doesn't ask for a raise.
it never asks for a raise to cover inflation. Its cost is fixed, and because of the physics of compute, it's actually deflationary over time.
It's that combination, 24/7, multilingual, flawless, zero HR cost that had every C-suite executive paying very close attention. But the final number, the one that seals the deal, is the financial impact.
The bottom line, this single move was reported to have boosted Klarna's raw profits by $40 million in year one.
$40 million.
In a single year. When a company can draw a straight line from deploying a technology to adding tens of millions to the bottom line, you realize this isn't about optimization. This is a hostile takeover of the payroll department. It's the direct substitution of expensive human capital for near zero-cost digital capital.
And once that's proven, the idea spreads like a contagion. This isn't just about customer service.
No, it's touching every job where the output is basically data or text. Look at Duolingo, the language app. They openly cut 10% of their contractors, human language specialists, because AI could translate faster, cheaper, and more reliably.
The service itself, text translation, was commoditized overnight.
And then you have the big guys, IBM. They publicly announced they were pausing hiring for about 700-800 back office roles.
And they were explicit about why.
Explicitly said AI agents would take over those functions.
Right.
We're talking about data entry, compliance checks, routine reports, the kind of work that generates text on a screen. That secure job is now a high-cost liability.
So if Klarna is the smoking gun, the proof that it works, then the crossover point is the economic physics that makes this whole thing inevitable.
It's not a choice, it's math. And it all hinges on the collision of two completely different economic curves. Curve A is the cost of human labor. Curve B is the cost of compute digital labor. The conflict between them is what's driving this wealth transfer.
So let's take curve A first, human labor cost. Why is our cost so sticky?
Because we're high-maintenance biological machines, our cost only trends one way. It has to go up with inflation. It has to cover food, housing, and then there are all the externalities.
Healthcare, regulations, retirement.
Paid time off, management, psychological safety. The cost of biological maintenance is inexorable. Critically, it never, ever trends towards zero.
Okay, now contrast that with curve B, the cost of compute. This is where it gets brutal for the employee class.
The cost of digital compute follows Moore's law. Computing power doubles about every 18 months, which means the cost to do the same task gets cut in half. And in the AI era, this is accelerating.
It's not just hardware anymore.
No, it's hardware with GPUs getting better and cheaper, and it's software with AI models getting more and more efficient. So the cost to perform a calculation, to generate a paragraph, to synthesize a report, it's not just going down, it's plunging exponentially, crashing toward a marginal cost of zero.
So you have one cost that always goes up and another that gets cut in half every year and a half.
And a CEO is looking at those two curves every single day. The crossover point is that inevitable moment on the chart where they intersect. It's the moment when a digital agent isn't just a little bit cheaper than a human. It's 10 times, maybe 100 times cheaper.
And at that point, the debate is over.
It's completely over. Once that crossover point is reached for any given task writing code, answering a customer, the laws of capital allocation just take over. Capitalism flows like water to the path of least resistance.
And greatest efficiency.
If a task can be done by a GPU and a model, it will be done by a GPU. Any company that chooses to keep the expensive human will be instantly undercut by a competitor who hasn't. It becomes an existential threat.
And this realization is already driving a huge shift in investment strategy. We can see the money moving.
And that's the key question for you as a listener. Where is the smart money going? They are dumping stocks that rely on heavy, vulnerable headcounts. Look at the pressure on big old school consulting firms whose whole model is charging a fortune for an army of junior analysts.
Or giant call centers.
Or global call centers, business process outsourcing companies. Their biggest asset, their payroll, is suddenly their biggest liability.
So what are they buying instead?
They're loading up on the companies selling the digital labor, the pick and shovel plays of this revolution. They're pouring money into the semiconductor companies designing the GPUs,
The foundational hardware.
the very hardware that makes the cost curve plunge. And they're investing in the platforms that host the agents, the big cloud providers, the foundational model companies. They're making a massive multi-trillion-dollar bet on the permanent deflation of the cost of human work.
Which brings us to the great collective mistake of the last 25 years. For so long, the advice was simple: learn to code.
It was the universal defense against automation. We all thought the robots were a blue-collar problem.
They'd come from the factory floor, the assembly line. We thought the cognitive class, the people working with text and data, were safe.
And that has proven to be profoundly, catastrophically wrong. The great irony of this revolution is that the AI came for the poets, the copywriters, the coders, and the accountants first.
Why did we get it so backward?
The answer is something called Moravec's paradox. The principle basically states that high-level abstract reasoning, things like writing code or a legal brief, are computationally easier for an AI than basic, real-world physical skills.
Like climbing a ladder or fixing a pipe.
Exactly. Plumbing is incredibly complex. It's adaptive problem-solving in a messy, non-standardized physical environment. Every job site is unique.
But code is structured.
Writing code is the manipulation of text of syntax within a predictable digital environment. The AI can master the grammar of Python far faster than it can master the unpredictable physics of the real world.
And the consequence of that is the collapse of the value of coding itself.
Look at tools like GitHub Copilot or these new autonomous coding agents. They're doing the majority of the grunt work now. Boilerplate code, unit tests, debugging. This is the commoditization of syntax.
So a skill that was once scarce and highly paid
Is rapidly becoming as abundant as oxygen. And if your core job is to produce text on a screen or to organize digital information, your value proposition has basically evaporated. The market will not pay a premium for a commodity.
So we'll get more software than ever before.
More software, more content, more of everything. But drastically fewer software jobs that pay a middle-class wage. The value is migrating from execution, the labor of writing, to architecture, the strategic design, and the ownership.
And that leads to this secondary, more insidious long-term problem. If the AI is doing all the basic work, what happens to the apprenticeship model?
It dies. And this is a critical structural failure. Think about how you became an expert in law or finance or engineering. You started as a junior.
You did the grunt work, summarizing memos, organizing databases, writing the simple tests.
It was the tuition you paid to learn the business. That grunt work was the latter. It's how you build context and learn the ropes. But now AI agents do that specific work information summarization flawlessly, instantly, and for pennies.
So from a purely financial perspective, why hire a junior analyst for $80,000 a year?
When their main job is to summarize a spreadsheet. A task an agent can do better in 4 seconds for 8 cents. The junior role becomes financially indefensible.
And the long-term impact is that companies just stop hiring juniors. They're removing the bottom rung of the career ladder.
We are burning the bridge to future leadership. If you stop hiring juniors today because AI handles the apprenticeship tasks, then where do the seniors, the partners, the leaders come from in 10 years?
The pipeline is broken.
Completely broken, which guarantees that human strategic talent will become intensely scarce in the future, while basic execution talent becomes hyperabundant.
And this structural collapse creates what our sources are calling the barbell economy, a hollowing out of the professional middle class.
Exactly. The economy is splitting into two safe extremes. On one end of the barbell, you have the protected class, the owners and the architects, the people setting the high-level strategy, owning the IP, managing the agent fleets.
The jobs that require complex human judgment, negotiation, empathy.
Right. And then on the other, equally safe end of the barbell,
The physical service workers.
the Moravec's paradox protection, the skilled plumbers, master electricians, HVAC specialists. Their jobs require complex, non-standardized physical labor that is exceptionally difficult to automate, so their wages are resilient.
But the vast space in the middle of the barbell.
That's the kill zone. That's where most of today's knowledge workers are, the email jobs. Mid-level cognitive workers whose job is to manage information, run reports, write internal communications. If your job can be done entirely from a laptop and the output is just text on a screen, you are squarely in the kill zone.
That's the segment facing the most rapid wage collapse and redundancy.
And that's the primary fuel for the great decoupling.
Which brings us to the end game of all this hyper-financialization. The money that's being saved has to go somewhere.
It does. And the concentration is becoming extreme. We're tracking predictions from people like Sam Altman who say we are about to see the first one-person unicorn.
A billion-dollar company run by a single founder managing a fleet of agents.
Think about that progression. Kodak, at its peak, needed 140,000 employees to be a global giant.
Then Instagram gets bought for $1 billion with just 13 employees.
And the next giant company will need 0 human employees beyond the founder. The wealth is concentrating into smaller and smaller hands.
As an employee, that's a nightmare. But as an investor,
It's the most profitable setup in the history of capital markets. Because the question is, where does all the money go when you eliminate 95% of the payroll?
it goes to the bottom line.
Directly. It bypasses all operational expenses, it massively inflates free cash flow, it funds huge dividends, and critically unprecedented stock buybacks. This is hyper-financialization.
So the margin expansion isn't just a little bump, it's structural and permanent.
The potential here dwarfs anything from the 20th century. Companies will scale revenue by orders of magnitude without scaling their costs. And the market is rewarding this. The more jobs a company cuts with AI, the higher its stock price is likely to go.
The market is pricing in the inevitability of the crossover point.
Precisely.
But we have to address the giant systemic flaw in all this, the macro trap. If we automate everyone's job, who's left to buy the products?
The existential risk. You delete the consumer, you delete the economy. It's a snake eating its own tail.
And the people driving this, the Silicon Valley billionaires, they're acutely aware of this, which is why they're so obsessed with universal basic income, UBI.
But we have to be clear, this isn't charity, it's self-preservation, it's market engineering. They're trying to build a floor under the consumer so the game can continue.
So UBI is just an economic lubricant to maintain demand.
It's welfare 2.0, and it will almost certainly be funded by printing money. So capital concentrates at the top, and the masses get newly printed dollars that are constantly being devalued by inflation. The hierarchy remains, but social collapse is theoretically averted.
And it gets even more interesting because the ultra-wealthy aren't just hedging financially with UBI, they're hedging physically.
They know the transition period between the death of the job and some Star Trek economy is going to be messy, potentially violent. You can't displace millions of white-collar workers without expecting massive social friction.
So they're preparing for that.
In a big way. We're seeing massive private investment in isolated, self-sustaining properties, bunkers in New Zealand, huge tracts of farmland in Hawaii. This isn't a vacation plan. It's expensive, personalized insurance.
They're preparing to survive the chaos that their own innovations are creating, while their portfolios profit from it.
They're hedging for a breakdown in social order while reaping the financial rewards of the forces driving that very breakdown.
Okay, let's bring this all back home. The verdict is in. The great decoupling is happening, the crossover point is inevitable, and labor is losing its leverage. The middle ground is gone. You're either a cost to be cut or an owner set to profit.
So the first step is a defensive audit of your own career. You have to be ruthless. If your job is fundamentally text on a screen or organizing information, you are in the kill zone. That value is gone.
The defense, then, is to pivot. Leverage Moravec's paradox. Move toward real-world skills that need a physical presence. Be the expert plumber, the master electrician. Those skills are scarce and resilient.
Or you have to ascend. Become the architect. Move into high-level strategy. These roles require complex human empathy, negotiation, judgment. The AI can execute the plan, but it can't define the human-centric mission.
But defense isn't enough to secure your future. You have to go on offense. This is mandatory.
You cannot compete with a zero-cost worker. The math will crush you. Therefore, you have to own them. You must switch sides of the economic ledger.
And that means investing strategically.
In the pick and shovel plays, don't chase the flavor of the month AI app. Own the deep infrastructure.
The platforms that host the agents.
The cloud providers, yes. And invest aggressively in the semiconductor companies that supply the raw computing power. They are the structural winners here, profiting directly from the rise of zero-cost digital labor.
The essential goal, then, is to acquire the scarcest asset in this new world: equity. You have to move your capital from the labor side of the ledger, where you sell your time, to the capital side, where your money works for you through ownership and automation.
The era of the employee is ending. The future belongs almost exclusively to the owner. You have to decide right now which side you're on and start positioning your skills and your portfolio immediately.
That is the verdict of the deep dive. The age of zero-cost labor is here. It's creating immense wealth and destroying jobs at the same time. The final thought for you is this. When your job vanishes, what fraction of the future automated economy will you own?